Boga boga.
Alright, so welcome to a new video. My name is Robin, and as per usual, I'm joined by Kirill. And today it's basically code red, or isn't it, Kirill?
It's a special
Talk us
day.
through it. What's
Yeah,
happening?
the big boss, Mr. Powell, had an announcement today where he said like the time has come. Literally, I think that's what they say on Yahoo Finance. Time has come for policy to adjust. Basically, yeah, I think this is a very important topic to discuss, especially right now, because it's all about lowering the interest rates down finally, because the inflation is getting better, presumably. The labor market is feeling worse. So Mr. Powell and the Fed decide to actually, finally lower it down. But now the question is, for everyone who invests, how is it actually going to affect your stocks? How is it going to affect your investments? How is it, of course, going to influence S&P and the whole world economy, because United States is the biggest one out there. And for that, we can actually use our 930 app, because what we got here is also a lovely thing that is called a macroeconomic dashboard, where you can track many lovely things. And we just want to show you some very cool things in here, especially when it gets to the comparison of like different macroeconomic items. For example, government debt to GDP ratio, GDP growth rates, federal funds rate, inflation, as you can see here as well. But the most important part is the correlation between the federal funds rate, which is right now at a little bit above 5%, right? And the S&P 500. And as you can see here, there are two graphs that are on the same scale pretty much. The orange one represents the federal funds rate over the past 30 years, and the blue one is the S&P index. And what is essentially important for you guys to understand is the fact that at the time when the federal fund rates are going down, when they are actually decreasing it, and then they are making the money to be, less expensive to borrow from the banks, that's the times over and over in history we can see that the S&P would be going down. It's not going down when the interest rates are high, but they're going down at the time when they're actually lowering down. And you can see the same story happening in, for example, July 2000. You can see the same story happening in 2007. Only difference here is 2019, and the reason for that is just because the government was also giving a lot of money away, the helicopter money. But now we're facing similar situation, and most likely we will face, that euphoria will finally come to an end, and we will see at least a little bit of a slowdown of S&P and maybe a correction, hopefully. And that's really important for you guys to understand, because nowadays, after this announcement, everyone is super happy, everybody is hyped up about it. But you gotta brace yourself. This is the reason why Warren Buffett is also loading up on the treasuries. It's not just because he just wants this. It's not for fun and giggles. It's actually because everything is overvalued, and the interest rates are gonna go down soon. So,
Yeah. And also, if you've seen our latest videos, or at least if you've been following us for the past year, you will see that most of the videos we make are on overvalued companies. It's not that we pick overvalued companies. It's just the fact that there are so very few very valued companies out there. And I think that's really important to highlight here as well. And like you said, Kirill, if there will be a correction, then it's interesting to use our app to see what's currently at the right value, and then pick it up. And then you can also ride the wave when, like you said, people will have cheaper debt to spend. They will bring it, so it won't be as interesting to keep it in the bank, but just spend it on stocks, for example, and then you can ride the wave. And then when everything is overvalued again, you can do it all over again.
And the most important part also to highlight is the fact that when the interest rates are being lowered, there is a lag of around half a year to a year maximum before people are actually going to get access to the cheaper debt, because first it has to go to the banks, then it has to go to the companies, and that only then it will start reflecting in the prices, for example, because the companies have cheaper capital to afford. So be careful. Be careful. And if you wanna to actually track all of these metrics with us, you can also use our app, which is soon going to be launching, as well as our stock valuation tool that we've been showing with Robin for quite a while. Yeah, and that's pretty much it. We just wanted to, quickly highlight it and just say, yeah, be careful. Winter is coming.
Exactly. So now that you know this information and you have seen basically a sneak peek into our micro dashboard, we haven't really highlighted it yet. You also understand more of the value that our app will soon to be adding to your stock portfolio. So as always, make sure to follow us on social media, hit the like button, subscribe, and hit the bell icon as well, so that you don't miss any updates. Also, because now the app is not live yet, and you want to purchase it, you will have to wait until we announce it on not on Instagram, but on social media. So in the meantime, just go there and wait for the announcement. And with that said, thank you, Kirill, for explaining this topic to us, and we'll see you guys in the next video.
Suffer the joy.
Suffer the joy.